This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Amid so much news flow, investors have been well served checking their political leanings at the door, whatever they are, and focusing on what the markets care about. Irrespective of your outlook, stock prices are telling us things will go right. Up next, let's think about what could continue this bull run since the lows of 2022. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Happy to be with you. Welcome to the unofficial beginning of fall. I told you to expect a squirrely, for lack of a better word, September. History says it's been the worst month of the year for stocks. In fact, over the past 45 years, according to Bloomberg, September has been the only month when the S&P index has averaged a loss. And not only that, it's not just enough to know that it's been weak on average. It's another to see how often the month really goes south. In fact, in the last decade alone, 6 Septembers have ended in the red, with the past 4 out of 5 being particularly challenging, which includes, of course, a 9.5% plunge in 2022, which was deeper than the September drop in 2008. So this is a month that's challenging. On top of that, it's the first year after the election. Also, according to Bloomberg, August and September have been higher in the post-election year only 3 out of 18 times. Okay, so I'm not saying get super negative. Just expect some down days. That's all I'm saying. It was the worst week of really the last couple months for the Dow. You could expect more volatility going forward. But I didn't really want to spend too much time on the historical patterns. I wanted to spend more time on the general sense of angst that's kind of pervasive. And I realize that maybe some of this is coming more from our left-leaning clients than our right-leaning clients. But I think just in general, no matter who you are, no matter what your political leanings are, I think everyone has a certain sense of uncertainty, not sure exactly how things are going to go. One thing that I've really tried to hammer home over the course of the last few months, and really this goes back to January, is it's very important to separate your citizen hat from your investor hat, okay? There are a lot of things going on in society right now, as we all well know. Some people actively despise what's happening. Some people are vocally supporting what is happening. A lot of those things are not germane to investing. At least the market doesn't care about them. I'm not saying they're not important, but the market, they're not influencing asset prices. Now, they may eventually, right? Sometimes, like immigration, for example, regardless how you feel about this administration's policy towards immigration, that eventually could impact the economy in certain ways, right? I think we all know that. But for the time being, that has not been a market-moving event or series of events. And I think the other thing that people need to understand and need to remember is you can't draw a straight line between cause and effect. So, for example, a lot of people are spending time trying to assess the likelihood of sort of a White House takeover of the Fed, right? Packing not only the Fed chair with a kind of a pro-Trump candidate, but also replacing some of the Fed governors with folks that are more sympathetic to Trump's policies. But what we don't know is what the impact of that will be on prices in the future. So just because you might be convinced that something's going to happen does not mean you have any idea. I want to say you, I mean rhetorical you, me included. Any idea how that's going to actually affect asset prices. So be very careful about that. But what I wanted to kind of get to is, despite some of the uncertainty, despite some of the headline volatility, you might be asking, why are the markets doing as well as they are in aggregate, right? We're pretty close to the all-time highs. Well, remember, the market is a weighing machine over longer periods of time, beyond a day or so. That's what Benjamin Graham, the patron saint of value investing, always used to say. And the reality is, if you weigh the evidence, the market believes, whether you believe it or not, the market believes that the highest probability outcome is that profits and revenues remain high, the economy stays robust, a Fed cut is forthcoming, and all this kind of noisy political stuff that we read every day will eventually work itself out. Doesn't mean that there isn't a wide range of potential possibilities, contradictory outcomes to that. But today what I thought I'd do is, rather than go through a litany of risk factors, I want to talk about what could go right. Because that's what the market's saying. Again, not to repeat myself, but the market is saying that things not only could go right, that they will go right. And the stock prices and bond prices, for that matter, are willing to look past some of the potential risks, including risks to the labor market, risks of higher inflation. So let's focus on that. And by the way, what kind of triggered this for me was not only have I been getting a lot of calls from clients saying, hey, why is the market near all-time highs with this going on or that going on, but also saw a couple of headlines that I thought were interesting. Bank of America came out recently and said stocks could rally another 50% in the next 2 years. 50%. Well, it wasn't a fundamental call or really even a technical call. They were talking about the duration of the bull market. According to them, in the last 100 years, the average gain among 14 bull markets has been 177% over 59 months. Well, based on that, the S&P has more room to run, as stocks are only, quote-unquote, up about 80% since the October 2022 lows. Take that with a grain of salt, right? I mean, that's not really a prediction, but I did think it was an interesting headline. But the other thing is that I've really been observing recently, and it's worth noting, is if you look at what is doing well in the stock market and what isn't doing well, we have seen a pretty consistent, persistent rise over the last few months in consumer discretionary stocks, i.e. anything from hotels to airlines to restaurants to retailers. In fact, if you look at sort of technical strength, consumer discretionary has moved into the top 3 over the course of the last month, if you believe FactSet. So is it possible that not only is the market assuming things are going to work out, more specifically, is the market starting to predict, for lack of a better word, that the consumer is going to rebound? There's been a lot of talk about the consumer slowing down. The market is saying something different. The market is saying that the consumer is actually going to rebound. Maybe not next week, but remember, stock prices are often 6 months out in front of the economy. So sometime next year, the consumer might look better. But just more broad, so that's part of kind of what triggered this conversation, internal conversation that I've been having. So I thought I'd share that a little bit more with you. Just kind of flashing back to August, one of the things I felt was really interesting, we saw some real market rotation. Most of the rally since the April lows has been attributable to stocks like NVIDIA, the AI-related names. I mean, NVIDIA is up something like 90% off the bottom. I don't have the exact number in front of me, but something really significant. It's really been an AI-led rally. Now, that's not to say that other stocks haven't gone up as well, but that's where, at least at the S&P 500 index level, that's where most of the return has come from. But August was different. Those stocks took a bit of a backseat to other parts of the market that up until then really had been laggards. In fact, I was reading something from Strategas, the number one decile in terms of performance from January through July, so the best performing 50 stocks, had a negative return in August. The worst performing decile was up almost 4.5%. So you saw a real rotation. Specifically, we've talked about healthcare, how not only their performance and the valuation of the healthcare sector was almost extreme, well, not almost, has been at extreme levels relative to the S&P. 30-year lows in terms of performance and valuation relative to the S&P. Guess what the best sector was in August? Healthcare, up about 5% in aggregate. The energy exchange traded fund, above the 20 moving average for the first time in a long time. Banks, 100% of banks above the 200-day moving average. Again, these are measures of momentum. So, you have financials, healthcare, energy. You could also point to utilities. I mentioned consumer discretionary. Some of these other sectors that many of which had done nothing all year, or at least financials had done pretty well, but healthcare and energy had certainly done nothing all year, starting to engage. And I think the key point here is this is not just, a reversion to the mean or a valuation, people tired of the stretched valuations in tech stocks. There are fundamental underpinnings to this. If you look at FactSet estimates, the baton is somewhat being passed to the other 493 names in the S&P, but beyond the so-called Magnificent Seven. Those other 493 names in aggregate are expected to accelerate into mid-double-digit earnings growth year over year by the third quarter of next year. That's not to say that the Mag 7 names are not going to contribute, but from a sort of contribution perspective, the markets, FactSet, and their estimates are expecting much bigger contribution from some of these other areas. And one of the things I've pointed to before, and I've talked about this a lot, is the difference between a sector's earnings contribution to the S&P versus the market cap weighting in the S&P. In other words, sometimes sectors are punching above their weight or below their weight. So to give you an example, financials, according to Strategas, are roughly 20% of the earnings in the S&P, but only 14% of the market cap of the S&P. Healthcare, not quite as distorted, but similar message. Healthcare is about 12% of the earnings, only 9% of the market cap. When you get that kind of outpunching of the weight, as I put it, that is often a sign of undervaluation and maybe a precursor to some relative outperformance from a sector that maybe hadn't done as well. So we're definitely seeing that. So I bring all this up because in the context of what could go right. If we have a market that's a little less top-heavy, remember, up until August 1st, 60% of the performance in the S&P had come from 5 stocks, and they were all AI-related. Okay? If we start to get a market that broadens with fundamental underpinnings, technical underpinnings, and valuation underpinnings, I say this, with an if, we just don't know, but that would be a strong positive for really the foreseeable future, several quarters to come. And just in general, earnings should be considered a significant tailwind. I mean, we've talked about this for years. People talk about inflation and interest rates and Trump policy and Biden policy, and all these things matter. But nothing matters more to stock prices than earnings. Bottom line earnings, right? And not only, the quarter, we're pretty much wrapping up second quarter earnings reporting season. At the beginning of the quarter, FactSet consensus estimates were calling for 4% growth. We got almost 13% growth. Earnings have been much better than expected, and expectations for next year have been going up, not down, up. So despite tariff headwinds, despite concerns about the labor markets, the consumer, estimates have been going higher. Also double-digit range, 12, 13%, according to FactSet. So obviously things can change, right? Analysts have been fooled before, but for now, that has been a big reason and again, a notch in the camp of what could go right. Double-digit earnings, it's hard to have a bad market if earnings growth is, 12, 13, 14% year over year. Doesn't mean you're going to have a great market because some of it may already be priced in, but hard to have an outright bad market. The other thing is you're seeing it on the top line, right? So the bottom line being earnings, the top line being revenues. Strategas noted that one concern raised by many people is that tariffs would slow revenue growth and drive up costs, right? And that still may happen in a more significant way, right? But based on what we've seen so far, that theory has yet to materialize. The year-over-year change in revenues continues to outpace the year-over-year change in costs by almost 2 full percentage points, according to them. So what does that speak to? It speaks to margin. And once again, estimated operating margins are approaching all-time highs. At the S&P level in aggregate, almost 18% profit margins. So as long as margins are stable / improving, the market historically has avoided trouble. So that's another notch in the what could go right camp. And by the way, not going to spend too much time on this, but bottom line earnings are also being supported by companies buying back a lot of stock. S&P companies, according to Bloomberg, are expected to buy back over 1.1 trillion in shares this year. Trillion, which is supported by strong free cash flow, also expected to improve next year. That's very much a tailwind for bottom line earnings. One of the things we also talk about a lot, and I specifically talk about a lot, is how the market is not the economy and the economy is not the market. Well, we've seen, company, not only corporate earnings, but also revenues essentially outperform the broad sort of macroeconomic data. So just to get a little more specific on that, Standard & Poor's came out with some numbers, and based on the second quarter results, which again are almost complete, real revenues, so corporate revenues adjusted for inflation, according to them, up 4.8% year over year. That's well above the expansion average of 3.5% over the past 5 decades. Compare that to real GDP growth of roughly, give or take, 2.5% year over year. Companies are doing better than Wall Street. I know that's an unfortunate reality in some ways, but from an investor perspective, remember we're separating our citizen hats from our investor hats. That's a positive. And there are a couple big reasons for that. Beyond AI productivity and high margins, you also find that companies in the S&P 500 have greater international sales exposure than your average kind of U.S. company contributing to GDP, many of which are privately held. And that international exposure has benefited significantly from the weaker dollar, right? Because when those foreign revenues and sales are translated back here, the weaker dollar has made those more valuable, right? And then the other thing is certainly the fact that sales for the median tech company in the S&P, which holds an outsized weight in the S&P, have been so strong, right? So tech exposure in the S&P is much higher than tech exposure in the broad economy. So I don't want to harp too much on that, but I do think it is worth kind of noting just in general that I think corporate earnings have been better than maybe what a lot of people have expected relative to the overall economic performance of the United States. Let's put it that way. Okay. Now we know though that valuations can be somewhat limiting, so we've got to think about that. According to the Wall Street Journal, the S&P now trades at 22.5 times projected earnings for next year, well above the 3-decade average of about 17 times. And you're certainly seeing the same thing from a sales perspective. Companies are trading at about 3.2 times forward revenue, meaning investors are paying more than ever for every dollar of sales in the S&P. But when you kind of unpack that a little bit, I'm not going to sit here and tell you that the market's cheap, but a lot of that is concentrated in the 10 largest companies in the S&P 500. Ever since ChatGPT kind of came out, or at least was widely known in November of 22, the 10 largest companies have maintained a median price-to-earnings ratio of about 30, been as high as 46, with an average closer to 35, according to FactSet. Even today, we're still in that kind of 30 range, and the biggest 8 companies have a median price-to-earnings of about 36. You get even a kind of a wider spread versus the rest of the market when you look at price to sales. 10 largest companies in the S&P now at 9.6 times sales, according to FactSet. That's 3 times the average for the index as a whole. So what am I saying to you? I'm certainly not saying to you that, I do want to say it twice for emphasis. I'm not saying that the market's cheap, but I am telling you that a lot of the valuation extreme that people point to is concentrated at the top. You could kind of justify a lot of that by looking at the numbers. I mean, I'll use NVIDIA as an example. NVIDIA's forward price-to-earnings ratio has actually declined since 2018. At the same time that the stock price has gone from 5 to roughly 170. Earnings, the multiple has gone down. And that's because why? Their earnings growth has gone through the roof. So their earnings growth has surpassed a stock performance of going from 5 to 170. Okay, so I know that's kind of an extreme example of an incredible performance by a company that's already of significant size, but I think you get what I'm saying. And also just remember, and I say this almost every week, valuations are a poor timing tool, right? From 1980 through Alan Greenspan's famous irrational exuberance speech at the tail end of 1996, over that 16 years, the S&P was up 1,200%, actually more than 1,200%, roughly 16.5% or so a year, okay? From the time of his speech, which kind of spooked the markets, through the rest of that decade, the S&P doubled again. Up 26% through the end of 1999. Now, of course, we had the dot-com finally bursting in 2000. But the point is, the market doubled after the most prominent banker in the world warned everybody that maybe valuations were too extreme. I bring all this up for a couple reasons. One is to say that some of that rotation I mentioned earlier into other areas of the market is a positive. The fact that the rest of the market beyond the top 8 to 10 stocks is much more favorably valued is also a positive. But also, when we look to 2026, we have to think about, hey, who's going to kind of take over the mantle, right? If, in fact, some of these large tech stocks, plateau a bit or even go down because maybe their growth is not good. And this is a big if, by the way. Maybe they keep going up next year, but maybe their valuations get to a point where there's so much future growth priced into them that it's hard for them to really advance a whole lot further. And there's certainly risks to the whole thesis in the sense that we are starting to see a slowdown in capital expenditure growth. Free cash flow margins for the big AI companies has already started to decline. So, and there's some anecdotal evidence around this, right? I mean, Facebook/Meta, they just reduced headcount in their AI division. You're seeing data center new orders slowing a bit. Again, not to levels where we think the AI narrative is in trouble, but we are seeing some deceleration. So the question is, again, along the thesis of what could go right, who's going to kind of take over? Well, one of the big stories this year is that capital expenditures from the largest 5 AI-related companies, Microsoft, Meta, Google, etc., contributed more, the growth in that, I should say, the growth in that contributed more to the U.S. economy than all of consumer spending, the growth in consumer spending combined. However, it seems to me that there's a pretty good case for consumer spending picking up in 2026. And as I mentioned earlier in the show, that is being kind of portended by significant outperformance in consumer discretionary stocks recently. So what am I talking about? Well, regardless of how you feel about the recent tax bill that came out, some people love it, some people hate it. I get that. I'm not taking any side on this, but just looking at the facts of it, it's a stimulus of about 1% to GDP. And in early 2026, consumers are going to get, I've heard it put as a tsunami of stimulus, about $520 billion in stimulus, which is an incremental, according to Strategas, $150 billion versus this year in terms of refund tax payments on the back of higher state and local tax deductions, SALT, child tax credits, lower taxes on tips, senior citizen income, auto interest income, all those things, right? So that I don't think has been widely telegraphed. I've already mentioned in previous podcasts that there's also a tailwind to free cash flow for corporations in the way that they can expense certain things. But what has been less, telegraphed has been the stimulus to the average individual. Okay, so that's a pretty significant issue. And, and another thing that hasn't been talked about at all, but Strategas wrote a lot about it this week, which I'll be honest with you, I haven't thought about much, is the potential stimulus of the World Cup. biggest sporting event in the world, I'd argue bigger than the Olympics these days, of course, comes to the U.S. Economic projections that they quote suggest the event could contribute almost $17 billion to U.S. GDP, create over 180,000 jobs. Obviously, that's not going to impact every industry, but certainly could have an outsized impact on travel, hospitality, leisure. So the combination of that stimulus for potential consumer spending, but also a lot of the sort of industries around consumer spending, I don't think has been really disseminated much. And maybe it will start to be more so next year. But the point I'm making is I don't think there's an accident that the market, in terms of what's going up and what's going down, the market is starting to reflect that, starting to price that in. And by the way, we're seeing signs of global growth reacceleration kind of all over the place. Global auto stocks are improving. Home building stocks have picked up. 10-year breakout for the Shanghai index. Macau is also strong. Hints of life from European luxury stocks. Decisive breakout for the Japanese Nikkei. There's about 10 other things I could point to. But these are kind of, I don't want to use the word anecdotal, but these are data points that kind of individually may not send much of a message, but in aggregate, when you see 15, 20, 25 different indicators delivering a similar message, the market believes that global growth will pick up over the next 12 months. And by the way, Polymarket, which is kind of the online betting site that people bet elections, people bet everything on there now. The odds of a U.S. recession on Polymarket were at 66% in April. Guess where they are today? 8%. So that's the collective wisdom of God knows how many people kind of betting on where things are going to go. Just a few other things I'll mention. I'm not going to spend a lot of time, but other potential tailwinds. Of course, the Fed has been much in the news recently. Is that old kind of cliche that the Fed tells the market when they're going to raise rates, the market tells the Fed when they're going to cut. And the market is telling the Fed that they're going to cut rates in September. It's almost 100% pricing in of a Fed rate cut. I don't know how much of a positive influence rate cuts are going to have, but I don't think they're going to hurt much in terms of consumer spending, potential GDP. We talked a lot about the momentum off of the April lows. It's been about 100 days since then, one of the most bullish 100-day periods ever in U.S. history. And I'm not going to get into all the statistics because I've quoted them before, but when you have this type of momentum surge, which has only happened a few times, maybe once or twice in my experience since I've been doing this, and maybe only a few more times over the last 100 years. Yes, it's a small data set, but history says the markets will be higher, not lower, over 6 to 12 months. Anything can happen over 6 to 12 days, weeks. I mentioned earlier, September is traditionally the worst month of the year for stocks. But over a longer period of time, these are bullish signals, folks. These are not bearish signals. So that whole kind of what up has to come down analogy or truism, although you can't really call it a truism because it's not the case with stocks. But history says it's the opposite, that momentum tends to beget higher prices, not lower prices. Meanwhile, investor sentiment is not off the charts. You would think with markets close to the all-time highs that would mean that everyone's fat and happy and ebullient. And we are clearly seeing signs of speculation in some areas. But when you look at it, again, in aggregate, when you look at put-to-call ratios, the VIX, VIX, which is a measure of volatility, bull-bear ratios, American Association of Individual Investors bull ratios, all these things, we are not in super irrational exuberance territory. You've heard that old cliche, the market climbs a wall of worry. There are still a ton of investors out there very skeptical about these markets. That tends to produce fuel for higher prices, not necessarily lower prices. And even Wall Street, if you look at what they call sell-side analysts targets, these are the Wall Street analysts that work for firms that cater to individual clients. The average 2025 S&P 500 price target, from what I can tell, is about 2.5% below where we are today. So Wall Street has not gotten incrementally bullish, at least from that perspective. All right, I'm going to leave it there, and I want to be very clear. I am. You know us, right? If you've been listening to this podcast for a long time. We are cautious people. We are value investors. We very much pay attention to risk and the risk-reward trade-off. But I just felt it was really important to talk about the fact that, the market reflects the collective wisdom of millions of investors voting every day simultaneously. And the markets are saying that, listen, there is improvement on the horizon, whether you want to believe it or not. And yes, we have to be obviously responsible about valuation and what we're paying for future growth, which is why I spent so much time on the fact that the market is starting to rotate in some of those laggard and in some cases cheaper areas. So very important, of course, that we remain open to contradictory outcomes and other types of outcomes. But I find it very difficult to believe that somebody should be actively bearish at this point. You can be cautious, you can take chips off the table, you can rebalance, and you should probably do all those things. But to be actively bearish, I don't know that that position is supported by the weight of the evidence. That's the way that I would put it. I hope that was helpful. Stay tuned. I don't have a lot to say on the individual stock front today, but I do have a few things that I thought were worth mentioning. Stick with me. Back in a minute. The Magnificent Seven have become the Lagnificent Seven. The clear leaders of the past 2 years are now bringing up the rear. Is this just a correction or something worse? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As promised, I would like to bring you up to speed on a few of our top holdings that have been in the news this week. But remember, these are names that we own in our client portfolios. And so if you're a client, I think you can feel pretty comfortable that we've done our due diligence and feel that these are appropriate for your portfolio. If you're not a client, just remember that I can't manage through the podcast. You're going to have to do your own due diligence, your own research. These are also names that I own in my own personal portfolio, so you could consider that a conflict of interest. As I mentioned earlier, we're getting to the end of second quarter earnings reporting season. Only a few names really of consequence left. But there was some big news this week, market-moving news from Apple and Google, specifically Google. As you may know, Google has come under a lot of antitrust scrutiny. And finally, we heard back from Judge Mehta, M-E-H-T-A, who is the judge overseeing the antitrust case that the Department of Justice brought, and basically said they're not a monopoly. And it's interesting that they sort of took the position that a lot of people thought, which is that because technology has evolved and that AI searches, artificial intelligence searches, have become so prevalent, pretty much they said that it's not the case anymore that Google can have any type of competitive monopoly because there's so many threats to what they do. And essentially what the ruling permits is non-exclusive revenue sharing, which leaves Google room to continue their deal with Apple. So in case you don't know this, Google pays Apple, the exact details aren't disclosed, but somewhere around $20 billion a year to have Google's, Chrome and other browser and other services pre-installed on Apple products. okay? Basically, the judge said that can continue. But what they also did is they kind of limited it. So it ended up being a positive sort of win-win for Google and Apple. So from Apple's perspective, what the judge said is, yes, they can continue to receive that $20 billion, which really provides a lot of support to the services side of Apple's business. You know, the Apple Pay, the music library, all those things. But they're also allowed to renegotiate the terms every year. So there's a lot of room in this deal for Apple to, I'm not going to say they would ever fire Google, but to bring in competition for Google, to renegotiate higher terms, maybe add some more AI installed capability into their phones. Maybe it's through Google's Gemini AI product, or maybe it's somewhere else. So this really is a tailwind for Apple, and I think it removes some of the overhang from them. Google also, their stock price also responded well to this. Remember that Google had, coming into this week, had been, I think, the second or third worst performing Magnificent Seven stock this year, and the one that's trading at far and away the cheapest valuation. I mean, Google is basically a value stock trading at a discount to the S&P 500. Well, according to Goldman Sachs report, this really is a bit of a win for Google because they avoided the worst case scenario. They do not have to divest Chrome, which is their search engine, has almost 90% market share in search. And had they had to divest that altogether, that would have really problematized, I think, the Google story. And they obviously can continue to work with Apple. And I think the ability now going forward to really press Apple to take on their AI, like I said, Gemini product. So this was a pretty significant overhang on Google's valuation. I think one of the reasons they were only trading at 21 or 22 times earnings. And I don't think it's an accident that the stock popped on the news. So there are certainly risks to both stories going forward. I think Google really needs to show, of course, that AI can be additive to their business, not subtractive, if that's a word, from their business. Remember, a lot of people worry that traditional internet search will be completely replaced by AI. Of course, Google, if you've searched anything on Google recently, you know there is sort of that AI pop-up whenever you search something. So, but there is the risk that that starts to cannibalize their traditional search and therefore their traditional advertising revenue. So we'll see. But this certainly, I think, probably allows Google stock to re-rate in terms of the valuation multiple people are paying. From Apple's perspective, gives them a lot more flexibility going forward, really provides a tailwind to their services business that's been growing and is very high margin. The risk to Apple is they still need, I think, to show the average person, including me, why I should upgrade my phone, right? If you have a 3 or 4 year old phone, there just hasn't been that technological advance to say, you know what, my old phone's obsolete, I need to get a new one. And of course, that innovation is probably going to be installed AI capability. This might sort of open up the pathway towards that. So there are risks to Apple, but I think both names, this is kind of a win-win, and we'll see how it goes going forward. The other one I just wanted to mention briefly is Salesforce, symbol CRM. It's a Dow Jones component. Salesforce has had a lousy year, as have most big software companies, by the way, besides Microsoft. I mean, Microsoft's really the only big software company I can think of off the top of my head that's had a good year. And a lot of it really is because of AI. We all know that investors are almost buying AI-related names and the AI narrative exclusively. Other parts of tech haven't done anywhere near as well. And a lot of it is because, essentially, the wrap is that AI potentially stands to disrupt and undercut the immensely profitable so-called software as a service industry. So the logic is that AI, shops can sort of produce their own software super cheaply using their algorithms and then sell those products at lower prices and then take market share from traditional software companies. Goldman Sachs came out with a report earlier in the year entitled The Death of Software, okay? But what's interesting is they came out with another report just in the last week or so saying that the reality is actually morphing, and a lot of these software companies are rapidly embracing AI technologies themselves. So coming back to Salesforce, they have a traditional software business that's still growing, still producing a lot of free cash flow, but there's deceleration there. But they had this new AI-infused software program that has become their main growth engine and grew at 120% year over year. The problem is there's a huge sort of lift up front in terms of startup costs, the Salesforce, the installation. So the tremendous growth has not translated into tremendous financials, bottom line profitability. So when you look at Salesforce's quarter, it was good. I read a Deutsche Bank report. Deutsche Bank highlighted how they beat on the earnings, they beat on the revenues, they beat on the margins, but they were very conservative in their guide going forward and saying, hey, listen, we are embracing AI. It's part of our story, but it's going to take time for it to really, flow through to the bottom line. Wall Street didn't like it. Stock dropped on Thursday in market trading, and like I said, the stock has had a bad year. But here's the deal. They still produce a lot of free cash flow. They instituted a $20 billion share buyback program. Okay, so they're going to be buying back a ton of stock, which should support the bottom line. And they're trading about 16 times forward free cash flow, which is the cheapest they've been in a long, long time. So Salesforce is a value stock. And, unless there is a much more significant cannibalization of their existing revenues, I find it hard to believe that Salesforce is going to get a lot cheaper. But Wall Street wants to see that AI narrative really kick in. So if you're looking at the pros and cons and weighing them, I think the valuation provides them some support, but it's going to be a wait and see. There is some pressure on management to deliver in the upcoming quarters. So if you're an investor in Salesforce or if you're looking at Salesforce, I think you have to consider it a value name with some execution risk. Yet, if you're patient, there could be, a fair amount of upside. That's probably the way I would put it. Hope that was helpful, folks. As always, I know I covered a lot, but as always, I wish you good health and wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.